yeah, gold's going to 3,000 by the end of the year. And paying close attention to the markets, you are missing this completely and totally. There is your massive contrarian indicator. Not only are the biggest boys in the world telling you, yeah, this is where it's going, but you can't find it unless you dig. I don't know. To me, it's a massive contrarian indicator, and I would say that's probably selling it short from where it ultimately goes. This is all huge.
Gold. It's not just a metal, it's a safeguard for your future. In this insightful interview, Andy Schectman, CEO of Miles Franklin, reveals the trends that could reshape the gold market as we know it. With giants like UBS and Goldman Sachs projecting gold to reach over $3,000 by 2025, Schectman sees a clear signal for investors, a chance to act before the masses catch on. As central banks increase their gold reserves, could its real value be far beyond what we expect? Ignoring these shifts might mean missing out on one of the biggest financial moves of our time. This is more than a market trend, it's an opportunity. Will you take it?
You know, we're going the wrong way by lowering rates, at least on the front end of the curve. So what does that do to the back end of the curve? But you end up with a situation where this is a problem for funding our deficits. Ultimately, rates must go higher. So here we are again, lowering rates and perhaps setting up these institutions to load up on treasuries, only ultimately to see rates go the other way, because at some point you have to fairly compensate people for taking on all of this risk that the central banks are illuminating here, the default risk, the systemic risk, the inflation risk, and the de-dollarization risk. So yeah, I think systemic risk, and we've talked a lot about systemic risk, is something that will, it's the same way of saying counterparty risk. Counterparty risk is accentuated because of the systemic nature of everything. The domino right in front of you may not be the bad one, but it could be the 1, 2, or 3 behind you that you don't even see. Quite frankly, I'm surprised that we haven't seen a domino fall yet. If the government wants to move towards consolidating the banks, which I think they do, and I know Lael Brainerd does, to issue a CBDC perhaps soon, then I think you have to ignite that fuse. And what better way to ignite the fuse than to let a major player fail, inciting a bail-in, initiating a bail-in, which then really creates systemic risk as people in this country wake up to what a bail-in is and the ramifications of that, the consequences of that, as people run to yank their money out of all of the other banks, which creates more systemic problems in nature. It's real and might be the one thing that we are underestimating totally as to the real problem with the system. Well, I'm going to read UBS first because it's not as grandiose as Goldman. They're close. But UBS says gold has risen by 29% this year, consistently breaking records on the way up. Meanwhile, the metal has risen above our long-held year-end target of $2,600, ahead of schedule. And according to the World Gold Council, as I mentioned to you, it has historically rallied as much as 10% in the first 6 months after a Fed cut. We now expect gold to reach $2,750 per ounce by the end of 2024 and to $2,900 per ounce by the third quarter of 25. And so that's pretty significant, but not as significant as Goldman Sachs, who is talking about right now in the fourth quarter of 2025, by the end of the third quarter in 2025, $3,000 gold. By the end of the year in 2025, $3,080 an ounce. And this is elevated from $2,700 to $2,900 an ounce. Again, these banks are coming out and saying, yeah, you know, we're moving to $3,000 an ounce. And Goldman Sachs has said that they're being inundated with precious metals requests on their trading desks, which is a very, very, very big deal, obviously. And it is being evidenced by the first time in 2.5 years, we see an uptick in ETF holdings. And so as ETF holdings pick up, as the Fed pivots and lowers rates, probably another 50 basis points here in November, this is just rocket fuel for gold, which has done what it's done, again, rallying 29% and 47% since 2022 when we saw this divergence in 2022 where the ETF started to outflow in the US and gold started to go up really. And so this 47% gain since 2022, as the public has not been involved in it, with positive real yield and a strong dollar. Now you see dollar kind of hanging right at that 100 mark on the Dixie, and could very well fall from there and drop a little bit or maybe a lot, of course. And then you see that the yields coming down, and now the ETFs ticking up. This is all huge. And to see Goldman and UBS say these things is again very, very significant. They're acquiescing to the reality that, again, you can only manipulate a market over an extended period of time, done again by pushing it in the direction that it is going. And that is the key, that maybe these banks realize it's as dumb as a mud wall, like Bank of America, to be naked short in a market where the rest of the world is voraciously accumulating metal, to the point where just in the month of August, 8.1% of all the silver held that's available for delivery, and the LBMA was delivered 8.1%, over 25 million ounces in the month of August. So it's accelerating the acquisition of gold. And it's also being done in a manner to not upset the apple cart, as we talked about last week, with 160 metric tons purchased by Saudi Arabia, but not disclosing it the way they're supposed to the IMF, because they don't want to upset the big kahuna, the United States. And yet they're playing both sides of this game. Ultimately, if you just put all of these things together and realize that the commercial banks and the central banks, who are the most collectively well-informed and well-financed traders in the world, are telling you where this is going. And if you don't pay attention to the Goldman Sachs report or the UBS report, where the hell do you find it, right? Where are you going to find it on the mainstream? Are you listening to the mainstream, who isn't saying a word about any of this? It's not easy to find and read through these analyst reports for UBS and Goldman Sachs. It sucks reading it, to be honest with you. And they're 25 pages of a bunch of mumbo jumbo. And then they say, yeah, gold's going to 3,000 by the end of the year. But if you only relied upon, and that you consider yourself very well read by reading the Wall Street Journal, watching Fox News, and paying close attention to the markets, you are missing this completely and totally. There is your massive contrarian indicator. Not only are the biggest boys in the world telling you, yeah, this is where it's going, but you can't find it unless you dig. I don't know. To me, it's a massive contrarian indicator, and I would say that's probably selling it short from where it ultimately goes. A demand side shock where people were loaded with funds because they were given stimulus checks, and they were sitting at home, and they couldn't go out, and they were buying stuff online, massive amounts of stuff, right? And there was more money chasing goods that were not able to get in because of the log jams at the ports. So this is a supply side shock where it's now an issue of the ports shutting down and goods not being able to get in, but you don't have massive demand, right? It's just the flow, the supply chain flow is being stopped. During COVID, everyone was buying stuff from their computers at home, and all of that stuff couldn't get in. But what I'm getting at is that the supply side shock is far more damaging to the economy than the demand side shock, because the demand side shock, there was purchasing going on, and the economy was at least experiencing demand and purchasing and transactions, whereas here it's different. Here it's a situation of products just not being able to get into the ports, and that's a bad deal. And of course, you talk about the ramifications of things like medicine and food, perishables. The majority of all the bananas in the United States, 80% or so, I think, if I'm not mistaken, come from being imported. And you know what a banana looks like if it sits in hot weather for an hour, it looks bad. So you have really big problems in terms of perishables, meats and fruits and vegetables and medicines. It's a major deal. It really is. And it's not going to get better anytime soon. If you look at China as an example, and look at their ports. You have 10 people sitting in a room with computers and joysticks, and almost all of their port infrastructure is automated. You take a look at the United States, it's far from it. And this is what one of the problems is that the ports want to be more competitive, i.e. capitalism, and they want to cut their costs and increase their efficiency, which would mean less workers.
If you found this interview valuable, don't forget to like, share, and subscribe for more insights on the evolving gold market and the financial trends that matter. Stay ahead of the curve, hit that notification bell, and never miss an update. Thanks for watching, and remember, your financial future is in your hands.